Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Kansas City and Minneapolis wheat markets. Kansas City wheat. Well, all of a sudden things have become even more interesting here. Up until last week, or really the start of this week, prices had kept hitting and sometimes utilizing the bright red trend line, formed of the neckline of the small but influential October 2021 to January 2022 head and shoulders top, currently at 853. I had said repeatedly in my commentaries that this market had occasionally staged rallies up to the 50% Fibonacci line of the August 20 to May 2021 move at 900, but then these rallies had stalled and the market has instead turned and expanded the downside. As a result, the declines back in April constructed a monthly key reversal down and very nearly did the same for the month of May, but instead chose to make it a lesser outside month instead. These moves down and then back up apparently created a diamond pattern type highlighted in bright green on my daily chart, with the action from April, May and the first part of June. I repeat my comments on this diamond for an 8th week. You see, I was, and I still am, really not happy about this pattern type. But for July, it seemed to be useful. The reason why is that 7 weeks ago, the market broke up and out of this diamond pattern type, thus indicating an initial primary target X for such a move in the 902 area, just over the 50% Fibonacci line for the August 20 to May 2021 move, and with a further harder to reach secondary target X1 up in the 946 level. Last week, prices finally reached the primary target X at 902, before pulling back down with a 3-day bearish evening doji star pattern. Now on the way up, we had a lot of resistances before 900, and that explains why prices started to stutter up there back in mid-June, and again 2 weeks ago. However, in the end, the primary target triumphed. One of these resistances, now supports, now resistance I suppose, you already know about. It is the red neckline, but we also had the 2014 high at 856 and the 2013 high at 862, and especially the following three that really managed to erode the bullish incentive. They were the slowly dipping long moving average, currently at 851, the 50% Fibonacci line of the September 2019 to May 22 move at 881. This one had been especially effective, and obviously also at the 900 area, where we have the 50% Fibonacci line of the August 20 to May 21 move. These all work together in varying degrees to halt earlier rises, creating a horn top in mid-June, and then last week a 3-day bearish evening doji star pattern. This bearish pattern put at risk not only the previously mentioned resistances that had become supports, that this week have become again resistance, but it took out 2 key supports with a single day's action and a single day's pattern. This past Wednesday, we had an unusual key reversal down that sliced through the combination of the declining medium moving average, currently at 829, and a short medium moving average, currently at 826, which incidentally had also formed that day, between them, a dead cross. But back to last Wednesday's action, also punched down through and closed below the bright green trendline extension to the diamond pattern, currently 825, as well as the purple uptrend, currently 813, of what I had highlighted in recent weeks was of a really big inverted roof pattern, sometimes called a half diamond pattern, formed from the start of this year up to this week. Things did not stop there, as by yesterday prices had dropped down through and closed below the optimized dark blue December 2020 to date uptrend, currently at 785. It was as I warned last week, and I quote, "Given we have had one false break, it might be worth considering any further attempts higher with a great deal of care." End of quote. So where does that leave us now? Well, as target X at 902 has been reached, I think it appropriate to retire the secondary harder to reach target X1 at 946 and start to look lower. Thus, assuming this move lower is not a false break, then a primary target X2 for the inverted roof half diamond pattern on the downside will be down in the 733 zone, with a secondary hard to reach target X3 down at 646. This is only the first few days of this move lower, so it will still be a false break. Or could, let me rephrase it. So it still could be a false break. It might actually be genuine, but could be a false break. But those are actually the potentials for such a pattern as this inverted roof pattern. Finally, I will also look to reassign the December 2020 to date uptrend and even maybe downgrade it next time. Minneapolis wheat. Compared to Chicago wheat and Kansas City wheat, Minneapolis wheat had been somewhat easier to read with respect to what was going on and what the opportunities might be. In late February and especially at the start of April, the market constructed a very large bear channel that after a period of time morphed into what we see highlighted in dark blue on my daily chart, a descending expanding wedge pattern, currently 695 to 855, originating from December late last year, but really becoming evident from February this year. The upper trend line had been previously reinforced, sort of, by the declining medium moving average, which combined to help cap the market in very early April, and then mid-April, mid-May, and mid to late June. However, 2 weeks ago, the attempts higher resulted in a clear break above the upper trend line, and also the important declining long moving average, currently at 884. The market even utilised the long moving average as a base for the last attempt higher, all the way up to reach the 50% Fibonacci line of the significant August 2020 to May 22 move at 955. For all these actions, 2 weeks ago I was able to place some potential targets for this descending expanding wedge pattern on the upside. Thus, the primary target X was in the 997 area, whilst the secondary target X1 for this pattern was in the 1024 area. I also raised another potential pattern 5 weeks ago, and it was to look at the whole action since late February as a possible reverse head and shoulders pattern. I've marked the likely spots for the two shoulders and the head, and though it is sloped and not a perfect pattern by any means, it still has merit, especially when we take the upper trend line of the descending expanding wedge pattern as the neckline. Thus, since we had a broken higher in mid-July, I laid out some potential targets for this reverse head and shoulders bottom pattern. A primary target X2 in the 954 area, and a secondary harder to reach target X3 up in the 991 area. At the start of last week, prices reached target X2 at 954 before immediately dropping back down. And this was somewhat satisfying, but we still had target X3 up in the 991 area. Which brings me to another point, and I would like to reprise some of last week's commentary on this. And I quote, "It is to look at the action over the first 3 days of this week," so that's to look at the first 3 days of last week. Look at the first 3 days this week as a potential bearish evening star pattern, bearish evening doji star pattern. My thoughts on this pattern are mixed, because I know we had such patterns in Chicago and Kansas City wheat. It is easier to see the attempt being made here. However, I am not wholly happy with labelling such a pattern here compared to the others, so whilst I recognise him, I am not happy labelling it such, not yet." End of quote. Well, whilst I was not wholly happy with the pattern was wholly happy and confident with itself, and prices dropped down through all the moving averages, through the congestion at 872, 868, 862 and 849, and back within the descending expanding wedge pattern. The only recent support it has not yet tackled is the late May to date 2-pointer uptrend, which it's been tackling today. That's currently at 838. However, that doesn't look that strong right now, so it may be that we will have to start looking at congestion below between 800 to 820, but only if we have this fully confirmed, as July being a false break higher. Right now it does look like that, so I'll retire target X3 up at 991, much as I have already retired last week's speculative late May to early July bullish Andrews pitchfork. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.